Hello and welcome to an update from Luna Investment Management. My name is Alex Brandreth, I'm the Chief Investment Officer. Today we're going to focus on three different topics. The first will be the ongoing coronavirus that's clearly gripping our lives on a day-to-day basis. We'll also look at the US election, which is going to be at the beginning of November. And finally, we'll take a look at why investing for the longer term is what we focus on and what we think other people should be focused on as well. So the second wave, we're really seeing a pickup in activity and cases across Europe now. And it's not just the UK. I mean, we're very keep an eye on what's happening on a local basis, but it's just as important to see what's going on a global basis. Because when we're investing, we don't just invest in the UK, we're investing globally. And one of the best ways of thinking about this is the FTSE 100, which is our own stock market. 70% of the earnings that are generated are from outside of the UK. So there's very little that's actually coming from in the UK. So it's just as important to concentrate on what's going on outside. And this is just a graph from the BBC. It goes back through the summer. So you can see the number of cases per 100,000 people. This is up to the 23rd of October. And it's relatively up to date. And you can see up until September, cases were pretty subdued, apart from in Spain, which is the red line. But since then, and since October, you've seen a real increase in cases, particularly in Italy, the UK, and France is the green line there. So it's certainly something that's gripping European economies. And this matters because the more cases that you see, the tighter the restrictions become. And the tighter the restrictions become, then the bigger impact that you have on economic growth. And we'll talk a little bit about that later. It's not just a European phenomenon. This is US data as well. This is going back to March, so when it started to really hit the US economy and country. And the top, you can see the number of cases on a daily basis, and then sadly the death count as well in the red section at the bottom there. This is from COVID Tracking Project, and you can see now in the US that the cases are getting back to the highs that you saw in the summer. However, the number of deaths is still well below that. Now, with all of this data that we've provided here, there should be a number of caveats made. With mass testing really came into force into different countries at different times. In the UK, really, it was only the summer where mass testing started. In the US, they've been testing pretty frequently throughout. And there could be some questions with regard to some of the statistics that are being produced, but we can only go on the information that is provided. So what does all this mean? As I mentioned before, the number of cases increases, the greater the lockdown restrictions become. You've seen this in the UK in the tiering system with most of the North now in Tier 3, the highest that they currently have. You've seen tighter restrictions imposed in other countries, in Ireland, for example. Wales and Northern Ireland have also gone even further than parts of the UK. So there's definitely an increase in restrictions that come into force. And as we saw in the second quarter, this can have a very significant impact on economic growth. The UK in the second quarter, GDP contracted by a staggering 20%, which is one of the greatest contractions that we've seen since data began. So it can have a significant impact on the overall economic growth of the country. Not only is it impacting the economy, it's also clearly impacting ourselves on a day-to-day life basis in terms of what we can and what we can't do. But it's having a significant impact on companies in terms of how they reach their customers, in terms of how they distribute products, in terms of how they get people into offices on a day-to-day basis, which is having significant impacts on share prices and risk sentiment. So in October, you've seen stock markets globally more under pressure because the amount of cases have been picking up. This can also feel incredibly uncomfortable from a personal perspective, and also when you invest in it. It's not comfortable position when you're seeing stock markets falling. However, it's also important to remember that stock markets are also becoming cheaper. March, the middle of March, was actually the most recent low in stock markets. And if you think back to what was actually happening in March, that's when really restrictions were coming into force and we had a national lockdown. So yes, there can be a disconnect between what's going on with the stock market and actually what's going on with the economy. And markets move in anticipation and ahead of events. The moves that you've seen in October could be a precursor to the potential further restrictions that you're seeing in November. So it's important not to become too dissatisfied with what's going on with equity markets. It could be a very good entry point for a long-term investor. And we'll get back to that long-term investing point later on. And again, I'd highlight exactly what happened in March as being a good indication of that as well. It's important not to get too embroiled with bad news. It does feel like the press, etc., are presenting negative information with every single day with regard to how many cases we have, how many deaths we have, how successful a vaccine may or may not be. But it is important to remember that we're now 7 months down the line, and every day that goes by is a day that's closer to becoming a vaccine. And that can have a significant impact to the country and globally as well. So it's important not to completely disregard that fact. On top of that, you also seeing significant support from governments, significant support from central banks to really support economies during this time. It's not all bad news. There's significant policies in place to try and support the economy and individuals through this. Let's move away from COVID for the time being. We are very close now to the US election. This is a chart from the Financial Times, which goes back to the beginning of 2020, and it shows how the two candidates have been polling. Clearly, we know that polls have not been a fantastic guide to predicting future events. This is a poll of polls, so you can see all the different dots on the chart which represent different polls that have been cast, and it's showing us a similar picture in that the Democratic candidate Joe Biden is ahead of Donald Trump at the moment in current polls. Now again, 4 years ago it was a very similar picture, and obviously Trump came back to victory. In fact, it was really the last few weeks before the election that momentum got behind Trump. And if you're looking right at the end of this chart from October, you can see that that gap has started to slightly narrow. So you are seeing a slightly similar picture. Importantly for the US though, it's not national polls really that matter, it's the Electoral College map. And what we've shown here is a map from CNN on their predictions. You need 270 Electoral College seats to win. And at the moment, CNN are predicting that Joe Biden wins. You can see that right at the top there in terms of on his share of the vote. Now, there's 5 different colours on this. So a dark blue means that it looks like a solid Democratic seat. A light blue means that that state is currently leaning towards a Democratic candidate, whereas the red looks like it's a solid Republican Donald Trump seat, whereas a more pinky colour is leaning towards the Republican Party. Whereas you've also got these battleground states where it looks very close to call, and there's some very important states within there. Now, I've put a dark blue square rectangle there on this chart because there's 3-4 states included: Michigan, Wisconsin, and Pennsylvania. Now, those 3 states have a big electoral college votes. You can see the numbers under them. So Wisconsin's 10, Michigan 16, and Pennsylvania is 20. So they're big states and they have an important part to play. And you can see that at the moment they are leaning towards the Democratic candidate, Joe Biden, whereas these states actually determined the 2016 election, and Donald Trump won these. So these have swung back from Republican to Democratic Party. So if it remains as it is at the moment, then that is significant ground, and that's one of the reasons why the Democratic Party are ahead. Also is very important are these states in gold. Florida, 29 electoral college votes is extremely important state, and obviously that's where Donald Trump resides. So it'll be extremely important to watch how these states perform as we come up to the run up to the election. Another important state on at the bottom of the map is Texas, which has also a big impact. So it's something that at the moment is looking like it's leaning towards Joe Biden, and that's what it seems to be the expectation within in the public vote as well. But we're keeping a close eye on how this evolves. Now, what does this actually mean from an investment perspective? It's very difficult to make investment decisions, and it's often proven to be very a false decision to actually judge and make investment decisions based on political strategy. Also, if Joe Biden does win, there's a strong possibility, depending on the strength of the result, that Trump might not accept and contest the result. Now, we saw this back in 2000, and it went to the Supreme Court in the US, and that could add another level of uncertainty in markets because you've got a result, but it might have to be challenged and recounted. And that's particularly important this time around because you're seeing a significant increase in postal votes because of the COVID crisis in the US. So yes, this might not be an accepted result, and that makes it even more complicated when you've got such a significant postal vote as well. You might get into the vote counting when they're counting all the votes from the polling stations and then get to the postal votes later. So you might see a big swing, particularly because the Democratic Party have more postal votes than the Republican Party currently. Regardless of what happens and which way the presidential candidate goes to, what you've often seen is that markets are a bit nervous in the run up to the election. However, as uncertainty is cleared up and there's a bit more certainty and we know the environment that we're going to be in, it's often been an environment which is more supportive for markets. And again, the reason that markets have been weaker in October is a function of what's going on with COVID, but there's also this US election overhang as well, which is presenting some uncertainty in terms of what's going to happen in November. If, as it's currently looking like, Democratic Party do win, then it's also important to look at the policies that this has. Now, clean energy and infrastructure have been big policy stances from Joe Biden in his campaign, whereas there's clear areas that look less supportive. So defence, coal and offshore drilling are areas where they could be more under pressure. Now, we spent a lot of time there talking about two near-term events, both COVID and obviously the US election. But when we're investing, we don't think about what's going to happen next week for the US election or the next few months with regard to COVID. Yes, it's important and we can make some tactical adjustments. But what's more important is just focusing in on what's going on with the longer term. And when you take a long-term view, it can have a better impact on longer-term returns. So we've just got a couple of charts here that we'll go through. The first here is just showing a number of different indices and how they've actually performed over this time period. So let's go back to that. Apologies, skipped on there. The first is it's from Vanguard. It's got US equities, emerging market equities, European, UK, global equities, government bonds, both in the UK and globally, cash and inflation. You can see on the right-hand side how they have returned on a compound total return basis all the way back to 1990. Now, clearly, over the last 30 years, there's been significant developments. There's been a tech boom and bust. You've had a financial crisis. You've had a European debt crisis as well. So there have been a number of elements to cater for over the last few years. And what I really want to focus in on is the last recession that we had in 2008 and 2009, which is this grey area here. And you can see, yes, markets were weak, but when you're looking at a longer term picture, it really just looks a bit like a speed bump in the road. It looks like a small impact. And it felt, when you were going through 2008, 2009, it didn't feel like that. It felt people were being made unemployed, you had bank concerns, you had people queuing outside of banks at Northern Rock. So it didn't feel a comfortable environment to go through. But when you look at it from a stock market perspective and you look in longer term, as I said, it only really looks like a small bump in the road. Now, that's exactly how we're seeing COVID. Yes, it's horrible to be living through at the moment. 2020 has been a very difficult year for a number of reasons. But when you start to look over the long term, 3 or 4 years down the line, it's going to look like a bump on the road. It'll look like something that, remember what happened in 2020, remember how much of a bad year it was, because we move on, stock markets move on, companies move on. Purpose of showing this is also to show the annualized returns that you've received from these asset classes over 30 years. So US equities has been the top performer, which is this gold line, obviously more recently driven by the strength of the technology sector. But that's returned over 10% on an annualized basis. If you move down to that kind of turquoise colour, UK equities, you can see that the annualized return has been around 8%, which if you're looking back over 120 years of data, going back to the 1900s, 8% is the long-term expected return from investing in equity markets. And global equities below that is interestingly a very similar level as well. So if you're taking a longer term perspective, then you can expect to deliver 8% for equity markets. You're obviously not going to expect that on each year. In 2020 will be a year where some markets will definitely not achieve that, UK being one. We're currently 20% below the level that we started the year at. But US equities are very close to all-time highs. So it gives you an understanding that, yes, it might not be an 8% year this year, but it might be next year because of the growth you see come through. Now, this is a chart from Fidelity. This is just focusing on the FTSE All Share. And it really shows why being invested and not trying to time the market is so important. It is very difficult, and we don't do it, to particularly guess on a single day how an individual market is going to perform. And here you can see that over this time period, that the annualized return that you received is 7%. But what happens if you miss the best 10 days, just 10 days over this very long time period? Your annualized return goes down from 7% down to 3%. So just missing the best 10 days over a very long time period can have a significant impact on your overall total return. And that impact is increased, amplified, the more good days that you missed. So if you miss the best 20 days, the best 30 days, etc., and you get to the point where you're making a loss on an annual basis when you miss just a few good, a month's worth of good days. Now, why does this matter at the moment? Well, at the moment, markets are falling and we're seeing big daily losses. Now, equally, after you see this, and we saw this in March as well, you tend to see some of the best and strongest days as well. So it's equally possible over the next few months that you could see some of the best days from investment markets. So you could be missing out on these best days, which have a significant impact on your longer term performance. It's very difficult to get timing of this right, and that's why we stay invested for the long term, and we don't try and time markets. So just a few conclusions on what we talked on today. As we've mentioned, there's definitely an increase across the US, across Europe in terms of cases of coronavirus, which is going to have a negative impact on both the economy. It's having a negative impact in markets within October. With regards to the US election, it very much looks like a Democratic victory is likely, but we could have said the same thing 4 years ago, and this is when Trump gained his momentum 4 years ago. When a result is confirmed, and I think that's the important bit, because if it is contested, that could create some short-term uncertainty, then the US election could provide some relief to investors. We are expecting and we are seeing some continued short-term volatility within markets, and that's going to be continuing through the course of 2020. But equally, like it was in March, this could present a very good long-term entry point when you're ignoring the short-term noise and you're concentrating on your long-term investing. Now, when we're investing for you and our clients, then people are thinking not what's going to happen in the next 5 months, they're planning for what's happening in the next 5 to 30 years, depending on retirement expectations. So we are not focusing too much on what's going on short term and focusing on what's going on in the long term. And it's important, I keep saying this, it's important that this noise doesn't try to impact your own investment decisions as well. It can feel uncomfortable, we understand that, but it's important to try and ignore that as much as possible when you're investing. That's all from me. Hopefully you enjoyed that October update in terms of what's happened with regard to both the backdrop with regard to the US election, COVID, and how it's been impacting markets. But as I mentioned, it's important to focus on the longer